The markets, buyback, big tech, drive us higher. Can we sustain it to all-time highs? Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, show more for additional information, links to articles and information on today's video. Also, if you find this video of value, please do consider subscribing. So first up, question from a viewer. What are all these buybacks I'm reading about and how do they impact me? Well, here is Barron's from this weekend. Okay, the headline, binge buying the S&P. Big corporations have gone on a spending spree, repurchasing their shares. So, a couple other articles from last week. A lot of talk about this. Most importantly, as you see here, that red line, $650 billion in buybacks. So what does it all mean? What is the good and potentially bad on that? Well, first off, as a good, you can almost think of it like another yield, okay? Almost about 3% by dividing the repurchase amount by the $23 trillion market cap. Combine that with the actual yield of the S&P, it's about 1.9%. So potentially about a 5% dividend this year based on those buybacks. So the bad, think of it this way. Company A, hypothetical company, okay, has 100 shares outstanding. They make $100 in profit. Therefore, their earnings per share is $1 per share. Makes sense. Same company, let's fast forward, 2019, make another $100. But they've repurchased 20 outstanding shares. So what does that do? The 80 shares by the profit. Now earnings per share goes to $1.25. Pretty big surge, 25% surge. All the while, profits are stagnant. So you got to be careful here and look at these individual companies as you're buying them and making sure they're not just growing, which a lot have had. If you go back to that chart I showed a minute ago, a ton of buybacks here in the last several years. So next up, the numbers, week ending 5/11, across the board, green. We pushed ourselves up. Finally, well, when I say green, meaning everybody was up last week, although we still have a couple that are lagging a little bit. So no big issues here. So let's go to the big charts. So last week we showed this, a new chart. We showed our symmetrical triangle. Said, look, if we break out of this, that's a good thing, or do we come back and retest? Clearly, we have broken out. So this is one of the first true positive signs that we've seen in the market for quite some time. But let's take a look at the big picture here. Here's our year-to-date. Lots going on here. I apologize for that, but this is what we look at. First up, 20-day moving average, went through that. 50-day moving average in red. 100-day moving average went through that as well. Again, every one of those are a positive sign. Let's look at the rest of the chart. Bottom, VIX. Been talking about this for 2 weeks now. Once we broke below 16, that is more positive for the overall markets, and we're in the 12 range closing out on Friday. Top, relative strength. Have Michelle zoom in. Up at 61. We've been talking about stuck at 50 for quite some time now. So finally seeing some additional strength. So from here, what's left? Well, this week, the last really set of resistance, right? You get support at the bottom. That's clearly our 200-day moving average. But you still get resistance right now. It's the 61.8 Fibonacci retracement. Not going to get into that. Link below on what that means, but mathematical equation, and we've hit those numbers quite a few times. We did break above a while ago, as you see, and then failed. So 61.8 is my next big number here. I think that overall, when I look at the short-term view, they are in fact positive, as you would expect. So let's go to our midterm view. Weekly, you see the bullish trend line. We broke back up through the 15-16 support, all good. And then at the bottom, we're still showing negative divergence. That's with MACD, momentum, PMO, price momentum oscillator. Those two are still showing negative, although possible button hooks there. So at this point, our midterm view is still negative. How's it impacting our portfolio? Very slightly right now because we're overweight big tech. So, but I'm still a little bit cautious until I see that truly break out, but deployed more cash into last week. Next up, long-term view. Here's our monthly view. Clearly intact bullish trend line. So of course, our long-term view is positive at this point. How about market breadth? Where are we there? Well, we're again, as you would expect, seeing a nice little push to the upside. Above 60s bullish, meaning here are those companies above or below the 200-day moving average being the price. 63% for the S&P, good number. You look down below, next up is going to be NASDAQ, good number, 60%, and there's your mids and smalls, again, look very strong across the board. Next up, your 50-day moving average, so a shorter term view, and again, looks good. At the top, S&P 62%, above 60 is in fact bullish. So from there, NASDAQ at 59, right on it. Mids and smalls both look really strong as well. So again, not a lot holding us back. Let's see if we can get some breakthrough on that one level of resistance. Next up, sectors. So I've been showing this now for a couple weeks. These 5 sectors represent 76% of the S&P. Obviously, the NASDAQ is the biggest, 25%. So across the board, I think that the good news is we were up across the board last week. Good signs as far as all of the various sectors. So we're seeing everybody joining the party. Again, another good sign. One thing I am looking at as it pertains to sectors in tech, NASDAQ 100. That's where when we buy the NASDAQ, we buy the NASDAQ 100. One thing that is really starting to become concerning for me, the famous FANGs. You can look that up. But the FANGs, when you go back to 2012, 11% of the overall NASDAQ 100. So it's 100 companies, and this is by size. And now we're up to 28%. And you can see each year how it's gone up and up and up. So as the FANGs go, the market goes, no doubt. So across the board, U.S. equities, 8 of 11 in an uptrend. What does that mean? Well, that's up from 3. That's a good sign. As a group, we have switched to an up signal there. International, 8 of 53 in an uptrend. Same as last week. So as a group, we are still down. New section, tweets of the week. First up from Shaq. Well, CNBC, bringing on Shaq. He's got that piece of paper there. We have a link to this. NBA legend offers some free financial advice by using a piece of paper. Great little story here. Shaq is an impressive man. Watch a story on him on HBO Sports. Very successful, very smart with his business decisions. And for everybody, especially young investors, take a look at this one. Next up, from Gold Telegraph, you see consumer debt is up 50% from 2008. That is not a good trend, my friends. So we have to be careful there. In the first quarter of 2018, Americans owned $3.824 trillion, up 5%, same period last year. Everyone is piling on the debt. Automobile debt, $1.1 trillion, and credit card debt, just under $977 billion. That is not a good thing. Last one here from Liz Ann Saunders from Schwab, since 1950, midterm election years have seen an average of 17% maximum drawdown concentrated in the first 3 quarters, going up to the actual midterms, with an average subsequent 1-year rally of 32%. Is this a sign of things to come? We will continue to watch this one, Liz. Great information. Next up, Treasury spreads continue to get thinner. 10-year minus 2-year Treasury down to 0.43. Again, really get concerned when we get to an inverted minus 0 yield, but you see across the board, all of those continue to go up. The one thing with the Treasuries, here's your 2-year. Your 2-year, and this comes from Bloomberg, has now broken above the yield of the S&P. So last year, it was all about Tina. There is no alternative. Now there is an alternative. We'll see how that plays out. Next up, what's on my radar? So last week we talked about semiconductors. Actually 2 weeks ago, been watching them. And yes, I did add to several portfolios this week. You can see kind of went with that double bottom, pretty classic. Started to go up. We got in early in the week, had a nice little pop. So we'll see. I think that we still have a way to go here. But to be determined, that's part of investing, right? Next up, how about the banks, financials? They've been a bit of a dog. You see a breakdown to the downside, okay? But same thing. You actually have your bottom there, kind of consolidation, and then you're coming back up above the 50-day moving average. So found its support at 200, broke above 50, been out of financials here the last quarter. This might be a spot that we start adding again as we go forward. Keep in mind, as treasuries go higher, as do banks. So, next up, what keeps me up at night? So this quarter, we've had a great earnings season. Couple reasons why. We discussed earlier, 77% of S&P companies have beaten sales estimates to date. If we hold that number, that's going to be one of the highest quarters ever, okay? So pretty strong, but here's the issue. 58% of companies have issued negative earnings per share guidance for Q2, well below the average of 72. Student debt, we just showed one of the tweets about debt. How about student debt? $1.5 trillion. Big issue. Got my first going to college next year. I think that number is going to go up a little bit. How about housing? Remember before the housing crisis and things were getting out of control? How about buying this little beauty in San Jose for $1 million? That's right, $1 million. Look at that dog. Can you believe that they got away with this? I think there's a little bit of a housing issue out on the West Coast. Tell me if I'm wrong. Wrapping things up, fear and greed this week out of the fear section into a neutral of 55. Kind of goes in line with our signals. Our signals being short-term positive, midterm negative, and then long-term positive. So that gives us our neutral feel right now. So as always, thank you so much for watching. This is Michael Loftus for Wealth and Wisdom TV.